Hi, this is Justin McNichols with Osborne Partners with your latest investment team video. In this video, I will preview the domestic equities asset class for 2023 after a really rough year last year. In 2022, investors faced some unprecedented combination of headwinds, which included the Federal Reserve increasing short-term interest rates from 0 to nearly 4.5%. Inflation rose at the fastest pace in 50 years. China's economy was essentially closed due to COVID. And finally, 2021's speculation and high valuation experienced a complete reset. And this chart below, this table shows that 2022 was the fourth worst year since 1960. And that was the result of all of these headwinds. Big question is what happened? Well, first, inflation reached a 50-year high, as this chart depicts. Additionally, that caused the Federal Reserve to raise interest rates, and they raised interest rates at the fastest pace in many decades, again, as shown in this chart. What happened was the high interest rates absolutely destroyed speculation, which was dependent on interest rates being tethered at 0. And three examples here, although there are dozens and dozens of examples. We have Tesla down 70% plus in the upper left. We have Bitcoin that went from 55,000 down to 15,000. And then I chose the marijuana index as a third example of how speculation absolutely imploded last year. Additionally, though, in less speculative areas like the S&P 500, you saw valuations compress, and this chart shows a very short one-year period of the S&P 500 price-earnings ratio on a forward-looking basis using forward earnings. And as you can see, we went from a PE of 24 down to under 16 in a matter of about 8 months last year. Additionally, all of those factors caused earnings estimates to fall. This is an example of fiscal year 2 years ahead and where estimates were. They were close to $260 last summer. They dropped to $228 a share as an estimate, really just 5 months after that. And estimates have settled in around 230 at this point. So you really saw estimates fall as analysts feared that the high interest rates was going to cause a potential recession or at least a slowdown and hurt earnings. However, by the end of 2022, inflation, which was a big headwind, had peaked at 9.1% and fell to 6.5%, under that actually by the end of the year. Interest rates, the Fed funds that had increased to a range of 4.25% to 4.5%, now it appears that Fed funds may peak at only 5%. That means we're 90% of the way through the hiking cycle. For as far as valuations are concerned, as I mentioned, the S&P 500 went from over 24 times earnings to under 16. The more volatile, growth-oriented NASDAQ 100 peaked at over 31 times earnings and bottomed at 18 times earnings at the October lows. And at those October lows, our internal risk reward on the S&P 500 was at a point where we have had about a 4-to-1 upside to downside. We felt there was about 5% downside, about 22% upside. And earnings estimates for 2023 that had peaked at over $251 a share, they're presently around $225, $230 and falling. So as we look at 2023, the big known unknown is earnings. Now, this is a little bit of a tongue-in-cheek slide here, but we list the top 10 worries of 2023. And you can see number 1 is earnings, and so is number 2, and so is 3, 4, 5, 6, 7, 8, 9, and 10. So although the valuation multiple fell 30% to under 16 times in October, the big question is, will 2023 earnings be over $220 a share, or will it fall to say under $200 a share? And that is the huge question and the big unknown for 2023. And that's the difference in our minds of the S&P 500 trading at 3,400, which would be down from here, or 4,500, which would have reasonable upside from here. So looking at our positioning and characteristics of our domestic equities portfolio at this point, although we're style agnostic, which means our universe of potential investments doesn't shift in and out of favor for years at a time, essentially means we can internally buy anything in portfolios that we feel has the best fundamentals and risk reward. But if you look at our positioning at this point, we show two tables here. The first one is our sector weightings versus the overall market. Our big sector overweight is consumer discretionary, additionally, communication services, while at the same time, we are underweight consumer staples, we're underweight real estate, we're underweight utilities, and temporarily we're underweight financials. From a portfolio characteristic standpoint, this is something that we're really proud of, is that it's very typical that our portfolio has much better metrics than the overall S&P 500. And in this case, our portfolio is on average larger than the S&P 500, has a smaller dividend that it pays, but on a price to book basis, it's cheaper. On a price earnings basis, it's cheaper. On a growth rate, as far as earnings concerned, our average company is growing its earnings at 15% versus 11% for the S&P 500. Our historic earnings growth has been higher than the overall market. And then, of course, we own a portfolio that's far more focused and concentrated than the S&P 500. So in looking at what that means as far as new purchases in the portfolio, here are the new purchases that we made in the fourth quarter of 2022 as the bear market had corrected to extreme levels, where at one point the S&P 500 was down over 26% from its highs. And again, being style agnostic, if you look at our latest 2022 purchases toward the end of the year, we had two companies that you would describe as defensive compounding growth companies. That's Copart and Pool Corp. One overly beaten down growth stock, which is Salesforce, and one that you would term cyclical technology, and that was a semiconductor company, AMD. So the interesting part about that low in October 22 was that our new investment watch list for domestic equities was the lengthiest it had been since March 2020. So we were seeing a lot of opportunities, hence a number of new purchases. So thank you for listening to our latest video, and we're excited to share our opinions on other asset classes for 2023 in the upcoming weeks.